So how do you pay zero tax when investing in property? Good question. Now, I'm going to unravel this myth. People think that, to lower your tax or pay no tax, you got to buy, negative geared properties and use that strategy, use that scheme to buy just an investment property that is going to cost you money, but you don't have to pay any tax. So how do you get around it? How do you have a property portfolio that is producing income, that is putting money in your pocket every single week, every single month, every single year, and you're paying a little tax? Now, you can't get away without paying tax, but you can minimize your tax. Now, I just want to touch on and put a disclaimer in. This is no financial advice. This is not legal, or this is just general advice. I'm not a licensed professional. As a tax agent, I'm a property buyer's agent, licensed property buyer's agent, so I can't give advice on taxes, but I'm giving general advice on just certain vehicles that you can use, or certain tasks or investment strategies that you can use to help lower your taxable income. So let's get into it. So when I'm investing in property, I'm looking at a large range of things. There's multiple things you're looking at. You're looking at renovation, you're looking at high growth areas, you're looking at cash flow positive, you're looking at what type of property you're looking at, what type of structure, what type of property that you need for your portfolio. You're looking for something that's going to produce a significant amount of income, if it's commercial, if it's a block of units, or you're targeting something where you can add value by renovation or doing a subdivision or a development in the future. There's so many things that we're targeting. But when it comes to taxes, I'm targeting these 5 things that I'm looking at for when I'm investing in property. Now, the very first one is depreciation. A lot of Australian investors don't understand depreciation, what it is. Now, what it is you're getting a quantity surveyor who goes into your investment property and does a depreciation report. Now, he is looking at the fixtures and fittings and the building structure and seeing if you can claim a certain portion of depreciation on the property. Now, let's just say the property is 10 or 20 years old and they've done a depreciation report, and you can claim, say, $7,000 off your taxable income. So your taxable income, let's just say you're making $90,000, you're going to be around the $20,000, just over $20,000 of taxable income that you have to pay tax on, $20,000. So if you get $7,000, you're going to reduce that off your taxable income. So instead of paying $20,000, let's just say hypothetically, you're going to be paying $13,000. So you're minimizing your taxable income. It's a great way to lower your taxable income by buying properties that have depreciation on it. Now, some properties that we purchase may not have depreciation. And depreciation goes off by a certain year as a cutoff date. If the property was built after 1987, I think it is. And if it's built after 1987, there's a possibility you can claim depreciation. But saying that, if the property's had a renovation, an upgrade, and an extension, you can still claim depreciation. Even if that property was built in the 1950s, you can still claim depreciation. Just it comes down to seeing what was done to the property and how long ago. So this is a great way to lower your taxable income. Another way, number 2, is different entities. So purchasing properties in different entities, not in your own name. And so that comes down to trusts and putting them in bucket companies and minimizing your taxes, and so how you can put it to beneficiaries or different people, and you distribute your profits so you don't put it all under the one name where you're going to get taxed at a larger tax rate. So this is a way to minimize your tax. Now, some people think we should just purchase property all in our own name if you're not, even if you're a PAYG. But there's a point where if you're building a large property portfolio, you're gonna have to learn how to minimize the tax and how to defer that tax. So it comes down to structuring, and structuring is a great way for this, and as well, it's a great way to protect yourself from anything from getting sued or losing your properties. Number 3, claiming expenses, of course. Your rates, your water, your you know, if you've got any repairs on the building, your interest repayments, etc. You can claim these things. Now, if you do renovations and things like that as well, that's something you can claim, and you can help you with your taxable income as well. If you do things, and what I want to touch on back up here, let's say you do a renovation to the property, you put, you know, some new appliances, like you put some dishwasher, you put some aircon in the property, you know, you've fixed the structure of the property, you've maybe done a pergola at the back, etc. Those sort of things you just don't want to get and claim on tax, which you will and do, and you should do, but you want to as well depreciate them too. And that's where you get a quantity surveyor to come back in and actually inspect those renovations, and so you can actually ride them, those repairs or those fixtures and fittings that you've installed into the property, you can write them off for a certain year. For example, carpet can give you up to 25 years of depreciation. So every year you can depreciate, 25 years, you must have heard me wrong, 25%. And I think it gives up to 8 years of depreciation. So up to 8 years, you can claim 25% of that carpet that you've installed up to 8 years. So it gives you, you know, every single year you're writing off that off your taxable income. So this is a great way to, you know, to minimize tax. Now, using other people's money. What does that mean? So instead of using, you know, your own money for a deposit or using your own money for renovations, there's a time and place where you can take that, you can redraw your property, equity out of the property, and use that to put down as a deposit, to use it to pay for, you know, renovations, etc. Now, that money that you're taking out as equity and using it as a deposit, for example, you can claim that on tax. So that 10% deposit or 20% deposit that you've extracted money out of an investment property, and you put a 20% deposit, say, on another investment property, that 20% you can claim on tax. You know, if you had your own money and you put your own 20% deposit from your own personal savings, you can't claim that on tax. So this is a great way to use other people's money, the bank's money, because it's tax deductible. That's a great way to lower your tax and help with your tax. Last one, accountant. Get a great accountant, an amazing accountant. Accountant understands property. An accountant that is a property investor, that knows the laws, that knows the legislation, knows the loopholes. Legally, not doing it in a crooked way, but in a way that he knows all the new legislation laws. He knows how to minimize your tax. He knows how to get the best situation out for your personal situation. This is super important. You want to make sure, hear me again, your accountant is a property investor and is an successful property investor, because they know then what are the loopholes. They're bullish on property. They understand property. You know, you don't want to go to your general accountant that does your normal tax return. You want to make sure that you can get the best possible outcome with your investment properties. So having a team around you and an accountant especially is going to help you. It's going to help you get the result you want and help you minimize your tax. So hopefully this video helps. And like I said, you get your advice from a professional tax agent that is trusted, that is a property investor as well. So you can get the right advice for your personal situation. So I just want to do this video so you just get a bit of understanding. You get an understanding of depreciation, different entities, claiming your taxes, you know, using other people's money to help, you know, claim those taxes and those deductions, making sure you have a great accountant on your team, which is one of the most crucial things that you need as a property investor, having the right people on the bus. So hopefully you got something from this, and I think you will, because there's a lot of value here. A lot of things that people forget about, especially depreciation and different entities, etc. So I'll leave this with you guys, and hopefully you got something from this.